In this video, I'm going to show you a simple scalping strategy that has helped many traders identify high-probability trading opportunities every single day. If you want more videos more often, please hit the like button and type 1 under comment, as it allows for our team to keep producing videos on YouTube. The best part is that you don't need any complicated indicators or expensive tools to use it. It's completely rule-based, and all you need to do is follow a simple 3-step checklist before entering a trade. To show that this strategy isn't just theory, I'll walk you through several real trading examples from Forex, gold, and cryptocurrency markets. Another advantage is that this strategy is flexible. Even if you already have your own trading system, you can easily combine these rules with price action, market structure, trend analysis, support and resistance, or smart money concepts to improve your trading accuracy. So, what is the strategy for this strategy? The only thing you need is one candle. You might be wondering, can a single candle really help you build a profitable trading strategy? It sounds too simple, but the answer might surprise you. The key is that we're not using just any candle. Instead, we're focusing on the very first 4-hour candle of the trading day. This candle provides valuable information about the market's early price movement and often acts as a reference for the rest of the day. For example, if you're scalping on a 5-minute chart, this range can serve as a guide to identify potential entries throughout the trading session instead of entering trades randomly. The best part is that this strategy is very easy to follow. It only requires a simple 3-step checklist, and once you understand the process, you can repeat it every trading day. Step 1. Open your chart in TradingView and switch the time frame to 4 hours. Each candle now represents 4 hours of market activity. Before identifying the candle, make sure your chart is set to New York time, because this strategy is based on the first 4-hour candle according to the New York trading session. Once the time zone is correct, locate the first 4-hour candle of the current day. For example, if today is June 23rd, simply find the very first candle that opened on June 23rd. Next, mark the highest point and the lowest point of that candle. Then extend both levels across the chart until the end of the trading day. These two levels become your 4-hour range. One important rule is to wait until the candle has completely closed before drawing the range. If the candle is still forming, the high and low can still change, making your range inaccurate. Once the 4-hour range has been marked, you're ready for step 2, where we'll use this range to build a simple scalping setup and identify potential trade entries during the day. Before we continue, if you'd like to see my daily market analysis and trading ideas, subscribe Paradise Trading Tips and type 1 under content. Now let's move on to step 2 of the strategy. Once you've identified the 4-hour trading range, switch down to the 5-minute chart. This is where we'll look for high-probability scalp opportunities. So, the setup we're looking for is when the 5-minute candle closes outside of the range, either the range high or range low. However, not every breakout is valid. The candle must close completely outside the range. If only the wick extends outside while the candle closes back inside, the breakout is considered invalid and should be ignored. Once a valid breakout has occurred, don't enter immediately. Instead, patiently wait for price to move back into the range and close inside it again. This return move confirms that the breakout may have been a false breakout. After that confirmation, we move to step 3, our trade entry. In this example, price first broke above the range high before closing back inside. That gives us a short selling opportunity because buyers failed to hold the breakout. Place your stop loss at the highest point reached during the breakout. For your take profit target, aim for at least twice the distance of your stop loss, giving you a minimum risk to reward ratio of 1 to 2. In this case, price eventually falls and reaches the profit target. Let's look at another example, this time using Bitcoin on the 5-minute chart. The 4-hour range has already been marked, so step 1 is complete. Now we focus on finding another setup. We can now move to step 2. Look for the trade setup. Price initially moved below the range low, but only the wick extended beneath the level. Since the candle closed back inside the range, the breakout wasn't confirmed. We simply ignore it and continue waiting. A short time later, another bearish candle closed, completely below the range low. This time, the breakout met all of our rules and became a valid signal. Now, we wait for price to re-enter and close back inside the range again. And right here, the candle closes back inside. So, that completes step 2. We still don't enter immediately. We wait until price returns and closes back inside the range. Once that happens, the setup is complete and we have confirmation to enter a long trade. For the stop loss, we place it at the exact low of the breakout move. And for the take profit, we set it at 2 times the size of our stop loss. As you can see here, price moves up and hits the taker at target. Remember, as long as you're still trading within the same day that the 4-hour range was created, you can continue looking for additional setups. However, every new trade must follow exactly the same rules. So, as we let the chart play out, we can see that price is trading well outside of our 4-hour range. However, it didn't manage to re-enter again until the end of the day. That means for this trading day, there were no more valid entries to take. But even with getting just one trade today, it was a high-quality setup and we walked away with solid profits. On this Bitcoin chart, price breaks below the 4-hour range, closes outside the range, and later closes back inside. We can see price broke out and closed below the range low. Then it quickly closed back above. That gave us a long entry. The stop loss is placed below the breakout low, while the take profit is set at 2 times the initial risk. As expected, price rallies and reaches the target, delivering another clean 2-hour winner. After that, price moved outside the range again, but never returned to close back inside. Since our conditions were no longer satisfied, we simply stayed patient and waited for the next trading day. Let's continue with the next trading day. Just like before, the first step is to mark the high and low of the 4-hour trading range. The breakout candle closed outside the range, but shortly afterward, price returned and closed back inside the range. This is exactly the confirmation we're waiting for, giving us a valid short setup. For this trade, the stop loss is placed at the highest point of the breakout. The take profit is set at 2 times the amount we risk. Later, price continued lower and eventually broke below the range low. After breaking down, the market reversed and closed back inside the range again. This completed another valid setup, but this time it was a long trade. The stop loss is placed below the breakout low, while the take profit is set at twice the stop loss distance. Once again, price rallies and reaches the target, giving us another successful 2-hour trade. On the same day, price gave us another setup. It closed above the range high, but then closed back inside. That signaled a valid short entry. We placed the stop loss above the breakout high and targeted a take profit equal to 2 times the risk. The market moved exactly as expected and hit the profit target, securing another 2-hour winner. Later that same day, the market experienced a very sharp sell-off, creating a much larger breakout below the range than usual. Eventually, price recovered and closed back inside the range, giving us another long setup. But here's the thing with this setup. The breakout was quite huge, which means if we were to place a stop loss at the low, it would be a very large stop loss. In situations like this, it's often better to use the nearest important technical level instead of the extreme low. On this chart, a nearby resistance level had already been formed, making it a much more practical location for the stop loss. For the taker, set it at 2 times risk. Here, price hits the target perfectly. Another 2-hour profit secured. That wraps up all of the valid setups for this trading day. Again, we have the 4-hour range marked. Price broke below and closed under the range low, but then came back inside. That gave us a long entry. We entered the trade by placing our stop loss below the breakout low. To maintain consistent risk management, the take profit target was set at 2 times the size of the stop loss. Now, the reason I'm showing you this is because I want to be fully transparent about the results of this strategy. I'm not only going to show you the wins, but also the losses. Later that same day, the market presented another long setup. Price once again broke below the range before returning and closing back inside, giving us another valid buy signal. We followed exactly the same process. The stop loss was placed below the breakout low, while the take profit remained at 2 times the amount of risk. After that, price didn't re-enter the range until the end of the day. So that wraps up today's session. Now let's see the final results. Here you can see all the trades we backtested. After completing our backtest, we recorded a total of 7 trades. Out of those 7 positions, 5 reached the take profit target, while 2 ended in losses. Overall, the strategy generated a total return of 8R, while achieving an approximate 72% win rate in the cryptocurrency market. For such a straightforward trading system, these are very encouraging results. Now, of course, if we want to get a more accurate performance, we would need to backtest using way more than just 7 trades. The goal of this example isn't to prove that the strategy is perfect. Instead, it's to demonstrate that even a simple trading system can produce consistent profits when combined with discipline, patience, and proper risk management. Now let's see how this strategy performs on the Forex market. In this example, we'll use the EUR-USD currency pair, but the same rules can be applied to almost any Forex pair. Go to the time zone setting at the bottom right of the chart and select New York time. Then find the first 4-hour candle that formed on the current date. Since this example takes place on August 4th, we simply locate the first 4-hour candle that formed on that day. That candle becomes our reference candle. Draw one horizontal line at the candle's highest price and another at its lowest price. Then extend both lines until the end of the trading day. This creates our 4-hour trading range. Next, go down to the 5-minute time frame to look for the setups here. Price closed above the range high and then back inside, so that is a short setup. The stop loss is placed just above the breakout high, while the take profit target is set at twice the amount of risk, maintaining a 1-to-2 risk-to-reward ratio. Shortly after, price re-entered again, giving another short setup. Stop loss at the highs, take profit at 2 times risk. This time, price hit the take profit target for a 2R gain. On the same day, price gave another short setup stop loss at the highs, take profit at 2 times risk. Price then hits the profit target, giving us a 2R gain. But then price gave yet another short entry, stop loss at the highs, take profit at 2 times risk. Overall, the strategy produced multiple high-quality opportunities while maintaining clear and consistent risk management throughout the day. Moving on to the next day. Here we marked the 4-hour range. Then price quickly gave a long setup. We placed our stop loss below the breakout low and set our take profit target at 2 times the amount of risk. Price continued moving higher and eventually reached the target, giving us a 2R profit. Later, during the same trading day, another long opportunity appeared using the exact same setup. We followed the same risk management rules, and once again, the market reached our take profit target, producing another 2R winning trade. After that, price broke above the range high, but never returned to close back inside before the trading day ended. So there were no setups taken. Now let's test the exact same strategy on gold. We're using the 5-minute chart, and the daily 4-hour range has already been marked. Price broke below the range low. After it traded below for a while, it then closed back inside, which means technically this is a valid long setup. However, the breakout was unusually large. Placing the stop loss at the absolute low would have created unnecessary risk. Instead, we used the nearest important technical level, which in this case was a nearby order block, as our stop loss location. In this case, there was an order block here, which we can use to set our stop loss. We then set a take profit at 2 times risk. The take profit target remained at 2R, and shortly afterward, price moved higher and reached the target. Shortly after, price broke above the range high, but closed back inside. So this is a short entry. Stop loss at the highs. Take profit at 2 times risk here. Price hits the stop loss. So that's a 1R loss. Then price traded above the range for a while before closing back inside, giving us a short setup. Because this breakout extended much farther than usual, placing the stop loss at the absolute high would have created unnecessary risk. Instead, we selected the nearest resistance level as a more practical stop-loss location. Price moved lower and reached our target, giving us another 2-hour winning trade. Moving on to the next day, we had the 4-hour range marked. Price later broke below the range low before reversing and closing back inside the range. This confirmed a valid long setup. We placed our stop loss below the breakout low and targeted a take profit equal to 2R. And price hits the target, so that's a 2 gain. Shortly after, price re-entered the range high, giving us a short setup. Stop loss at the highs, take profit at 2 times risk. Price hits the take profit once again, another 2R gain. Not long after, price moved above the range high but quickly returned inside the range. Another short setup. Stop loss at the highs, take profit at 2 times risk. Here, price hits the profit target, securing another 2R gain. After some time, price gave another short setup. We place our stop loss at the highs, take profit at 2 times risk. This time, price hit the stop loss. So that's a 1R loss. Now moving on to the next day. Price broke above the range high and re-entered, giving a short entry. Stop loss at the highs, take profit at 2 times risk. Price hit the stop loss, a 1-hour loss. After some time, another short setup appeared. We entered the trade using the same rules, with the stop loss above the breakout high and the take profit set at 2 times the initial risk. This time, however, the market reversed and hit our stop loss, resulting in a 1R loss. But then price re-entered the range once more. So that's another short entry. We entered the trade by placing the stop loss above the breakout high, while the take profit target remained at twice the amount of risk. This time, the market moved exactly as expected, continued lower, and successfully reached our target, giving us another 2R profit. Out of those 10 trades, 6 were winning trades, while 4 ended in losses. Even with several losing positions, the strategy still generated a total return of 8R. Based on these results, the strategy achieved approximately a 60% win rate on the gold market. These backtesting results clearly show that the 4-hour range strategy can be applied successfully across different markets, including Forex, gold, and cryptocurrency. That's why I strongly encourage you to backtest it yourself and adapt it to your own trading style. If you found this lesson helpful and enjoy learning practical trading strategies, don't forget to subscribe to Paradise Trading Tips and become part of our growing trading community.